Hey everyone, welcome back to the next milestone, milestone 4. We'll be making a portfolio. So this is a bit of a longer one. So let's just go in, making a portfolio. So here we'll make a low risk portfolio of mainly index, ETFs, etc., and learn how to make changes to them to become a higher risk profile portfolio. For example, then finally ending up with maybe, let's say, single tech stocks and crypto. And so first off, we'll make a $100,000 low risk portfolio and then go through some portfolio examples that then increase in the level of risk, just so you know how to go through it. So the first example portfolio, which we think is a great portfolio, distribution is as follows. Just remember that this is not investment advice. This is just some educational examples that we'll go through and show you how to create it in the brokerage app. So, I mean, we see here, 20% VOO Vanguard S&P 500 ETF. So that's the name of an ETF from Vanguard that tracks the S&P 500. There's also an iShares version from BlackRock, but Vanguard has lower fees. The difference is marginal between BlackRock and Vanguard, but in this case, the VOO Vanguard has slightly lower fees, but it's like 0.001 or 0.02% difference in terms of fees, so it doesn't really make a difference. Then we've got the SWDA.L iShares Core MSCI World UCITS ETF. I know that's a mouthful, but that's basically the tracker index for the world economy. Then we've got the Vanguard Total Stock Market ETF. We've got the Vanguard Growth ETF, focused on mainly growth stocks and growth emerging economies and sectors. And then we've got also the QQQ Invesco. So you can always look at individually what these are, and we'll actually go through that. But this would be like an example distribution of a portfolio where you have 20% of this, 20% of that, 20% of that. You have things a bit spread out. And we'll show you now how to go into the app and make this portfolio. So let's go into eToro. We had the portfolio that we already had previously where we tested around with a couple of things, and you'll have your own portfolio as well in the demo when you made your first demo investments. But what we're going to do now is we want to start with a clean plate. So let's just get rid of all of our positions. So we'll go into here. We'll go close all. So just close. Close all. Here. Oh, oopsie daisies. Here we'll also need to close this. Oh, let me move myself to the side. Close all. Amazon, close all. So remember what does closing mean? It means closing our position. It means if we're buying, if we have a stock or an index fund or anything bought, that we're on a long position, so we're pretty much buying and hoping the price will increase. We're pretty much selling that position. Alternatively, if we were in a short position, and remember, short is pre-selling something into the market and hoping you can buy it back for cheaper. You're basically, by closing the position, you're basically buying from the market to pretty much close up the pre-selling that you already did. But obviously, we won't be doing any shorting. You'll always be buy and hold investing. And we just need to close all of these. Right now, though, I see here it's some of the things that I wanted to close are pending because the markets haven't opened yet. Here, we'll close the investments that we had into the smart portfolios that we had. So close investment, stop investing. Amazon, okay, that we already tried to close. We'll close the investment that we have in our copy trading. We want to get as close to a blank slate as we can. Whoops, it is. Let me go back. Okay, Joseph Greenwood, we want to stop copying, close all, confirm. And yeah, these things will be pending. It will take some time for them to properly close up. But for now, we have most of our cash now available. For now, just ignore that I have this here, but we'll start going into creating this distribution portfolio. So since we have 100,000, where we should be having 100,000 in total, we'll want to put 20,000 into each of these. So what do? We find the ETF that we want, so VOO Vanguard. We'll just go into the search part here, VOO Vanguard, S&P 500. There you go. You can always look how it's performing in the last week, in the last year, 3 years. So, I mean, overall, it's been like steadily increasing. It had a bit of a dip during 2022 period, but I mean, almost everything in the markets in 2022 took a dip. But anyways, you can always find information about what it is, what the ETF tracks. So this gives exposure to large companies that are listed on the stock markets in the United States. And then, yeah, you will then click trade. Same as we did before, I showed you how to buy something. We want 20%, so 20% of 100,000 is $20,000. We want no stop loss. We can put a take profit at 200,000 so that it's, if we made 10 times our money, then maybe we sell into the market. We take that profit. It's going to set it to market order. So buy whatever the price is in the market at the time. And then buy, order received. Then we want to get through our other 20%. So SWDA dot L. So this is, remember, the global economy. So it also like displays here, seeks to track the results of the MSCI World Index. It's comprised of a range of equities from developed countries. It's administered by BlackRock, and yeah, that's basically a brief explanation of what it is. Remember, all of these things that I'm mentioning here, you can, when you do your own research, or if you do your own research of what are the best index funds to buy and what markets they're about, you can always research a little bit what these are about. But yeah, and you'll be able to also find them or find more of these ETFs in the Discover section. But yeah, anyways, we'll move forward. Set this to 20,000. Whoops, it is. Right. 20,000. Okay. Same as before. We want a 20% split. Done. Then we're going to do VTI Vanguard. VTI Vanguard. Bit of information, large, mid, and small cap companies, diversified across growth and value styles, managed by Vanguard again. And remember, Vanguard is the largest asset manager in the world, pioneered by John Jack Bogle, so pretty much the pioneer of index investing as a concept, so that's why Vanguard has a lot of ETFs named after them, because that's what they pretty much do. Now, Vanguard Growth ETF, Vanguard, oh, yeah, it's even suggested here. Boom, then we will do 20,000. Oh, just make sure that's a 0. Remember, always your leverage, you wanted to have it at 1 times. That means using no leverage. We always want to stay in that state. Never use leverage, please. I mean, you can if you want, it magnifies your position, but earlier you will have hopefully seen the CFD video where we explain what the huge risks are with that, and we want to minimize risk. We want to keep things reliable. We don't want to use leverage. And then finally, the QQQ Invesco. So QQQ should come up. There you go. QQQ Invesco. So here it's about an ETF managed by Invesco, and it tracks an index of the 100 largest domestic and international non-financial companies listed on the NASDAQ stock exchange. So yeah, it's in the top 1% of large cap growth funds. Remember, what does large cap, mid cap, or small cap means? It means like how big the company is. So large caps are, companies worth over $10 billion. Mid caps is more between the $250 and $2 billion range. And then small caps are less than $250 million. So that's basically the definition between large, mid, and small caps. So large caps are pretty much the very, very big companies. So yeah, now we will do, let's say, 20,000 of that, or since we haven't completely sold some of our other positions, we might not have 20,000. So yeah, we'll just do whatever remaining amount we have. So 7,900. Yeah, I'll just do 7,900. Take profit, yeah, 10 times, and buy. All right, ideally, we would have wanted to have 20,000 in this, to have a 20% distribution in this. But since the other positions in our portfolio of Apple, Microsoft, Amazon, some of the others haven't closed yet, they're still pending close. That's why we don't have that cash available to us yet. Although it seems we now just seem to have closed one of the other things, so we have an additional 4,000 available. But you get the point. Since these are reliant on the American market right now, these things are pending open. But once it's open, then you'll have your portfolio done. And then you'll have the distribution of 20%, 20%, 20% across a variety of different ETFs and indices. So you can also, of course, instead of buying the ETF that tracks the index, you can try to buy the index itself. But in our opinion, you might as well go for the ETFs that are managed by the large asset managers that track a particular index. So yeah. Now, going back into the presentation. Okay, so we have this portfolio It's a great portfolio. It's quite diversified across market ETFs. Of course, it's equities, so there's always a certain risk in their equities, and there'll always be volatility going up and down. It's not like you're investing in bonds or treasury bills. Some of you who may be retired, maybe you want to lower your risk and you want to invest more in bonds. That's something that is possible. For sure, you can try to put 20% or 40% into bonds or treasury bills. But the focus of this course is more on index funds. But of course, remember, there are always the smart portfolios offered by BlackRock, which we've gone through previously. But just to show you one more time, you can always go into the Discover section. We were previously invested in this, into the smart portfolios, but here, the core portfolios using models by BlackRock. You can go for conservative, where the return is much lower, and it's focused on fixed income products. Has then slightly more risk and return. Is then starting to blend the bonds and together with equities and alternatives for the more conservative investor. So yeah, this is like a great way. And you can also look into the portfolio and see what they're invested in to copy individual things yourself. But to be honest, if you want a smooth way to do things, then you may as well just use what's already created by them by just investing into the portfolio directly yourself. All right, anyways, back to the presentation. So that was portfolio 1. Portfolio 2, the only thing that we're going to be switching out here, and just to show you how to do it, is, okay, we'll keep the 80% invested in what we've already had before, but we're going to change the last 20% to go to then a sector ETF. So in this case, in the example, we're using the SOX iShares Semiconductor ETF. So investing in companies that are in the semiconductor sector. So for those of you who don't know what semiconductors are, they're basically used for chips. So let's go into our portfolio. And how do you make a change to a portfolio? So in this case, we're replacing the QQQ Invesco. So what we'll do is we'll try to close, or in this case, since it hasn't happened yet, we can cancel this position. Yeah, cancel this position. Wait. Cancel. Okay, cancel here. Done. We've canceled now our order. Obviously, if you made that order while the market was open and then immediately went through, you can just close and sell the position. But in this case, since it wasn't open yet, we can just cancel it. Anyways, now we have the cash available to us. And what we're going to do is we're going to go for the semiconductor, like the sector ETF that we're looking at. So SOX. Boom. So it's iShares, so it's managed by BlackRock. And yeah, you can see here the information. Tracks the investment results of the ICE Semiconductor Index. It's comprised of various US equities in the semiconductor and semiconductor equipment sectors, which may include companies of different sizes involved in the design, manufacture, and distribution of semiconductors. So it's, in short, a sector tracking ETF. So rather than the entire market of everything that's there, it focuses on a particular industry. So always check in the Discover section or Google if you're, particularly interested or you're particularly confident about the future of a particular sector, whether it's in semiconductors or financial services or, let's say, solar energy or green companies. There's always ETFs that track these particular sectors. And so, yeah, if we want to then invest into it, we've gotten rid of our QQQ investment, and now we can invest our money instead into, let's say, I think we only have $12,000 left. We can invest it instead into this ETF. We click on buy, order received, and then now we should have it pending here. So once the markets are open, this will be our distribution here. These figures here are blank right now because it's still pending open. So we're going to try to invest at the price that we want. But only once it's actually open and it commits to the investment, then we'll know exactly here how many units we have and in a long position, and then the value on the right here of how much is invested there. So now that's example of portfolio L2, where it's also great, but there's like exposure to a particular sector. So there's an increase in risk, or because if that sector has a downturn, we're a little bit more exposed. That's why we have it in red. But this is also technically totally fine. If you want to be a little bit more actively managed into your portfolio, we just want to show you how you would change your portfolio distribution. So you just pretty much sell something and then you buy into something else. And now we're going to portfolio H1. So now it's H because it's higher risk, where we start investing into individual stocks like Tesla, Microsoft, Coca-Cola. So in this case, I think we're getting rid of our growth ETF. and we're starting to invest into individual stocks. So if we go back here, we want to get of our growth ETF, which is, I believe, VUG. So let's cancel this. And then, okay, we now have more funds available now. And we can go into either the Discover section or just whatever it is that we want to invest in. So Coca-Cola, let's say. Can always Cola, just KO. We can invest into this. We can buy, we don't maybe want to go like the full 20% into Coca-Cola, but maybe we buy like only maybe 5,000 of Coca-Cola we buy here, and then another 5,000 into Microsoft Tesla. You basically know how to do it. You just go into whatever stock that you want to buy and you just do it. And then in the end, once all your money is invested, then you'll see the portfolio distribution here. Here, Coca-Cola is also pending because we're waiting on the American markets to open. But if you invest into a market that is currently open, for example, if I were to invest in a European listed stock, the order would just immediately go through and I don't have to wait for it because right now it's 247 in Spain at the time of recording. So we could invest into a European stock since the European markets are open. But yeah, that's basically how you would go about changing your portfolio. It's just selling something and shifting the capital instead into a different investment. Now, if we were to continue to go down this line of increasing the risk in portfolio H2, then this is a very heavy risk scenario, really not recommended at all, where we go away from the indices and ETFs entirely and we go full crazy on having an entire portfolio that is basically individual stocks, like automotive stocks like Race, Ferrari, or energy stocks like Chevron, Core, tech stocks like Microsoft, industrial stocks like Caterpillar Inc. that make tractors and construction buggies, things that lift dirt and you use in construction. And then, or no, 20% of your portfolio then goes into a cryptocurrency like Bitcoin. This is an example of a high risk portfolio, and this is not something that we would recommend. But this is, if you were to go about this, then you would just sell what you previously had and then you shift it over into the distribution of what you want. But anyways, that's just how you would do it, just showing you how you would go about it. But remember, this is not investment advice, it's just some educational examples, and these high risk things are not things that we would recommend. Even L1 is, great. It's diversified across a range of broad market tracking ETFs. But even this, if this is too complex for you, you can also just use a smart portfolio instead from BlackRock. It's something that really helps simplify how your investing is and managing your portfolio actively. Or simply, you can just invest into maybe 1-2 indexes at maximum. Many people who follow index passive investing just do 100% into this S&P 500 or whatever, or maybe a European local market into the FTSE 100. It's all completely fine. Or just investing 100% into the world MSCI. Just basically investing 100% into the world. These are just examples of how you would go about portfolio construction. But in the end, any portfolio that you create is good, but make sure to not investment advice from ours, but we think for ourselves that we should stick to only a few ETFs that track indices. So remember, here, be clear about what level of risk you're comfortable with, but we advise keeping with broad indices and ETFs, like I just said. But what's important is that once you choose your portfolio type, just stick to it and forget about it. Constantly stressing and adjusting your portfolio can be a huge waste of time. And remember, most actively managed funds that constantly shift things back and forth don't actually beat the market. So once you buy something, just leave it. You can just contribute more to it every month when you're contributing more funds to it. Either you can set it automatically to automatically invest for you, or more likely is that once you have the funds at the beginning of each month, you just go in and then just buy more of whatever it is that you're invested in. Don't try to sell or buy something at the perfect time. Remember, due to human error, you'll most likely get it wrong. And to be honest, it's a very, very, very small amount of people in this world who really do it for decades, can do this consistently, beating the market. And it's very unlikely that you will be able to do it yourself. Trust me. Just don't do it. You might get lucky. A lot of people get lucky for maybe 1-2 years, but doing it for the next 30 years and really beating the market consistently every year for 30 years is something that is very difficult. Now, you ideally just want to look at your portfolio actively once every 6 months anyways. You've got other things to do with your time. Investing should not be taking much of your time. It should be at max, ideally taking only 3 hours of your time per year. So this is something that should just be working by itself. So further thoughts on portfolio construction. There's nothing wrong with buying a stock that you believe in for the future of, but don't let individual stocks as a group go more than 10% of your portfolio. It's too risky and it takes way too much time to think about which stocks to buy. And remember what Rich BFF Vivian 2 mentioned before. Really smart rich people aren't sitting there for 12 hours a day doing investment research to pick the perfect investment. So if you want to dabble in a little bit more risky investing without consuming more time, you can use copy trading, which is one method, or more ideally smart portfolios of investors which you really resonate with and believe in. Finally, if smart portfolios from BlackRock are available for you, definitely, you should be using them. It's a super easy way to invest into a diversified portfolio according to your own chosen risk appetite without spending too much time. So that's what I was showing before with the core portfolios, where you can go from low risk to higher risk, or that are a little bit more bold and a little bit more equity heavy. So yeah, let me just show you where they are one more time. Just remember, you can go into eToro, you go into the Discover section, and you should be able to find them here, the core portfolios from BlackRock. You can also find other smart portfolios by going to the smart portfolio section, but it's very easy to find them quickly here in the overview section. You can just click whichever one that you're interested in, you view portfolio, you can buy, and it's basically how it works. All right, is there another slide? Yes, there is another slide. So, final thoughts. Now you know what portfolio construction is roughly about, but again, we just want to keep things simple. So as mentioned before, it's also fine to just stick to even one or a few index ETFs, like just investing in the world MSCI tracking in ETF, where you're investing in the world, or if you're investing in a particular country like the US with the VOO Vanguard S&P 500 ETF. The whole point of this is to just keep things simple and just let the power of compounding take its time. Now that the theory is over, here's what I like to do. This is just my personal preferences. This is not a recommendation, and it might not fit your personal tastes. I'm just showing you what I like to do. So if we were to go back into the portfolio, I can't actually show you like my actual real life portfolio, but I can give you maybe, my personal preferences. So, okay, it's a little bit annoying since most of these things aren't closed properly because we're still waiting for the US markets to open. So there's no clean portfolio for me to show you. But in short, I am a big fan of the world MSCI index. I'm a big fan of also the S&P 500. I'm generally very confident and bullish about the future of the US as a country economy and the innovation that they're bringing. You can also invest into the European markets. Vanguard also offers Europe MSCI trackers. So, what I would do is I'll keep the VOL, also keep the VTI. So let me just, these things are going through. I would personally, I'm not into investing into individual stocks, so I would actually cancel. I'll cancel this one. Even, I do believe in the future of Coca-Cola. I believe in the future of companies like Google, or like Alphabet that owns the company of Google, or Meta, the company that owns Facebook and Instagram. I'm a huge believer in these, but I know that stock picking is extremely, extremely hard. Sometimes you get lucky, sometimes you don't get lucky. It's not something that I want to do with my money. With my money, I want to build wealth reliably, so I'm really just going to stick to ETFs. So we've got the VTIs, we've got the VOOs, we've got the SOCs as well, and I actually would be fine keeping invested in the semiconductor ETF, as I am, with the future of AI and the future of computing, we will continue to need more semiconductors, and there will be a semiconductor shortage over time due to a variety of reasons. But in this case, I'll actually cancel this just to free up more funds for myself. Boom. And let's see here. Okay, this one's pending close. Okay, how much do I have now? Okay, I've invested into the world index, the Vanguard S&P. Actually, I'll get rid of the VTI because I'm not really interested in the small and mid-cap firms of the US. So I want to keep it to the S&P 500, so the biggest companies, the world index, and now I'll actually concentrate a little bit more into the VOO. So I'm a big fan of the US market, so I'll just, instead of 20%, 20%, 20%, I'm actually going to go a little bit more. Personally, myself, I'm going to add an additional $20,000. Whoop. $20,000. Buy. Boom. So I've got 32,000 left. I'm also going to invest maybe $10,000 more into the World MSCI. And then finally, what else would I rather do? So I've got the world, I've got the Americans, and actually I'm going to go into, which was the other one that I liked? So we've got the Vanguard, we've got the iShares. I want the Vanguard Growth ETF. So let's go Vanguard Growth. I'm a big fan of this. So there. There's also a Vanguard Emerging Markets focused ETF, which is also one that would invest in myself. But yeah, just for the interest of time, I'm not going to show you, trading everything, but those are the ones that I would personally construct my portfolio with. So rather than having it spread across too much, I like to just keep it simple. The ones in the world economy, the US, and the emerging markets. So that's where I would primarily invest in. I'll just keep it to 3. It's totally fine to invest into more. And also personally myself, if I discover any particular index funds through my research that I'm a big fan of in terms of that market as a whole, I would then also invest into that. But yeah, that's personally what I do. It's not a recommendation, as mentioned. It's just what I personally like to do. I like to keep things simple, and I like to just let compound interest take over. So yeah, that's basically it for this lesson. Whatever it is, whatever the portfolio is that you end up with, remember to take a screenshot. So either you use the snipping tool and you just snip, you just do the snip to show your portfolio, and then that's basically that. Actually, I want to make sure that I also have this row at the bottom to show the cash available and the amount totally invested. And yeah. Ideally, you have your whole cash available invested, since it's just a demo account and you just want to fully utilize all of your cash. In this case, I didn't because, well, I didn't invest my last amount. But yeah, you should ideally just invest all the cash that's available in your account to have it all invested. And then you can show your portfolio to the rest of the group. So yeah, I hope you enjoyed this lesson. Make your own portfolio. And remember, it's just a demo portfolio. Take a screenshot, and in the concluding modules lesson, we'll then post it into the community. All right, then. Enjoy. Bye-bye. See you in the next lesson.